To bring in our panel, what should the final housing aid package look like? Let's ask our Bulls and Bears panel. We have Gary Kaltbaum, Peter Schiff, and Todd Wildman. Todd, first to you if I can. So what we need to do, according to Neil, is still grease the skids at some point for this really stuck in the mud housing market that we have, but without rewarding speculators, without increasing the moral hazard. How do we do it?
Well, the first thing is we have to gut Barney Frank's bill. I mean, this bill is a boondoggle. It gives $25 million to La Raza, okay? All that is buying Hispanic votes for the Democratic Party. I mean, this has already gone way beyond helping housing, and this is a political boondoggle. We need to start over again. It needs to be much smaller and much more confined. I mean, it's nice that Barney Frank wants to buy votes with my tax money, but I don't like it.
Well, I don't know about buying votes for whatever you said, the Hispanic Party.
$25 million to La Raza, Liz. It's in the bill.
I'm not so sure about that. But, you know, I'd like to ask you, Peter Schiff, you know, there's a lot of irresponsible borrowers who defaulted on their loans. And the thinking is that, hey, you know, you have people who basically lied to get these no-income, no-asset loans, and now they can tell the truth and get these cheaper loans. Isn't this a fairness issue? And why isn't this a campaign issue as of yet? It doesn't seem to be on the campaign radar screen yet.
Well, look, there's a lot of moral hazards that they're creating. But, of course, the answer to the question is there should be no bill whatsoever. You know, the government already did enough damage by inflating the housing bubble. They have to sit back and let it burst. Are there going to be losses? Sure. Are people going to walk away from their homes? Yes. Are lenders going to lose money? They're going to lose a lot of money. But all these housing bills are going to do is make it worse. They might succeed in shifting some of the losses around, but in so doing, they're just going to exacerbate the losses. They're doing more harm than good. They have to stay out of the way and just let the chips fall where they may.
Gary Kaltbaum, it's an election year. We already heard President Bush say that he's willing to compromise. He did say he was going to pull out his veto pen if things got too bad, but he also said he wants to work out a compromise, and like the previous stimulus bill, perhaps there will be one. What are we likely to see come out of the Beltway?
Giveaways, giveaways, and more giveaways. That's what we've been hearing on a daily basis. Look, my biggest issue on the housing front, all this is going to do is put off the inevitable. The bottom line here, the only way to solve a housing problem is price and time, not intervention. You grease the wheels, it puts it off for now. My other big problem is who do you choose that had bad behavior and good behavior? And all you're doing is rewarding bad behavior. So the good behavior, they're going to be asking for more also. You're just creating what I call ridiculosity, and it's never going to end. It's almost like a never-ending cycle of giveaways in this election year.
You know, I got to ask you guys, anybody take this, Peter, anybody on the panel, because the government basically is stepping in and saying, hey, we will reward essentially irresponsible behavior. Do you think that lenders can then step back into the market? We know that the lending market is frozen, but down the road, could they say, hey, we're continuing to make irresponsible loans, knowing that the Fed or the government will step in?
Well, you know, I don't think the lenders are going to want to do it because I think a lot of the lenders are coming from abroad. And the more irresponsible loans that are made and the more the Fed says, hey, we're going to buy up all this paper, the more downward pressure they put on the dollar and the less likely foreigners are to want to lend us money.
Neil?
And the lenders are scared out of their boots right now. We went from the easiest lending in history to most restrictive lending in history in a year's time.
Well, hold on a second. Let me ask somebody with skin in the game. Let me ask somebody with skin in the game. Neil, is the lending now, has it become too restrictive?
In many ways, the lending's become too restrictive from a credit underwriting point of view. The pricing is starting to come back in line. But something that will happen under this bill that even the congressmen who are voting on it, I dare say, don't even understand, and that is many of the subprime people they're purporting to help will have no chance to qualify because they receive both a first and a second mortgage. If you have a second lien, you're not going to qualify because the second lien holder has to give their permission to write off all their equity.
I got to tell you, have former Federal Reserve panelist, member William Poole saying we're going to have a problem of the scale we had after Hurricane
Robert Gray. I'm sorry, Robert Gray's got the breaking information about
Hey there, it's Connell, guys. How you doing? Yeah, we're looking over these AIG losses that have just been reported, and it looks like, well, listen, the loss is $3.09 a share. I'm not going to go out on the limb and say that that's comparable to a 76-cent a share loss estimate, but you never know, as they say, when these things cross, because it very well may be the way these things have been going for this company. But the way, it's a very complicated, as you guys know, it's very complicated anytime you're talking about a company that has as many issues as AIG in terms of the financials of it, in terms of comparing a net loss of $3.09, which we're seeing here, is a huge, huge loss. That's, just to put it in perspective, in dollar terms, you're talking about losing almost $8 billion in a single quarter, $7.81 billion in a single quarter. They lost $4 billion at this time, or I should say they made $4 billion the same time a year ago. So they're losing almost $8 billion. They lost $5 billion the quarter before that. AIG has been in trouble for some time. Again, the street was looking for a loss of 76 cents. Whether $3 plus is comparable to 76 cents, we'll have to look forward. We'll have to look through the release in more detail. The revenue coming in here looks like first quarter revenue is $14 billion. If that's right, and I have no reason to think it wouldn't be, that's about half the estimate. I mean, the estimate was for more than $30 billion. They're looking for $31 billion in revenue, and instead they got 14, so that's nowhere close. And the loss looks like it's a lot wider than expected. But guys, give me a few minutes to
all right. Well,
look through the details on it. But this is a pretty big, this is a huge loss.
Donald, thank you
for that. In the meantime, the after hours trading doesn't show much of a loss. We are it's closed at 44.15. I'm showing 44.10 right now. Again, one would expect a little more downward pressure. Connell is going to be analyzing the figures, but from what you've seen so far, Gary Kaltbaum, what would you say about AIG?
Same old, same old. The company's got problems. We're hearing things that we should have heard 9 months ago. I think they said 3 months ago we're getting close to the end, and boom, here comes another one. By the way, I think the stock has stopped trading in the aftermarket.
I believe it has. I don't have the stop notice on my my system here, but I believe it has, because one would expect some movement, and we see 44.10 right now. Again, it's only 5 cents less than the close, and with information like this, perhaps they have stopped. We're going to be checking up on that as well.
But Neil, help me out. Help us put this in context. This is coming on the heels of a record loss, $11 billion. And what we got to return to time and again, what you're seeing in the financial sector, what you're seeing in the insurance companies, are these fair market accounting rules. I know it's geeky stuff, but it is roiling the stock market. In other words, these companies cannot go into the markets and get a price tag on these illiquid securities because no one wants to buy them. In other words, the rules say that you have to take a write down. In other words, based on what the market will prevail in terms of a price. And I'll offer it up to the panel. Should the SEC rather suspend or do an average rolling 6-month price for these illiquid securities, or do you still have them? Because AIG's chairman and CEO is saying if those fair market rules were not in place, it would only have taken a $900 million hit, not the $11 billion that it suffered. It's an interesting debate.
Peter, go ahead.
No, why should we just pretend that the losses don't exist? I mean, that doesn't make any sense whatsoever. In fact, if anything, they're probably not writing these assets down enough.
Neil, let me ask you something. The debate really is that some of these assets do still have cash flow behind them. Isn't that what you're hearing in the banking?
Absolutely true. And how do you mark to market when there is no market? So you have to go back to the days of commercial lending and apply some of those rules as to what the discounted cash flows will be, and don't look for a market.
Todd Wildman, I saw you looking off to your computer screen. Are you seeing anything about AIG right now?
No, it's still halted trading.
Yeah, I think it's still stopped. Go ahead.
But a lot of those cash suspend the mark-to-market for at least a year. Suspend the mark-to-market. I mean, that just came about. That was Rule FASB 157. That just came about 6 months ago. Let's rescind it for a year and get through this financial crisis right now.
So hang on. Let's get back to what Todd's saying. Hang on. Again, AIG is reporting a deeper loss, double than what analysts expected on an earnings per share basis. Todd, you're saying that they should suspend these rules for a year. Is that what you're saying?
Right.
And you're saying basically
they have not suffered the loss yet. There's no cash loss yet. I mean, there's assets backing.
So you're saying these are
obviously the assets are lower, but let's wait. I mean, people are talking about what's going to happen is in 5 years the assets are going to be worth more, and people are going to be adding it back to their balance.
Remember, that's how those Bear Stearns.
Hold on, whoa, one at a time, guys. Let's get some order here. Peter Schiff, go ahead.
Well, that's exactly what the hedge funds were doing before they blew up. They were marking these assets to myth. They were pretending they were worth more than they were. And the problem is when people want their money back, then you find out what they're really worth. You can't tell the shareholders and pretend that you have assets on the books that are worth something when you know they're not.
Gary, Peter raises a good point. In other words, that these rules allowed these banks and brokerages and these hedge funds, although they're not publicly traded, to report record profits. In other words, they were marking and an upside. A lot of these assets enjoying a very sweet upside to earnings. What do you say to that?
They got away with it for years, and they took billions of dollars worth of fees. I got to tell you, 20 miles from here is Fantasyland and Disney World. That's where they were marking their prices. There should be full and fair disclosure. That is what my business is about, of managing money.
Hang on a second. So, in other words, on the upside and on the downside, in fairness, I think you should maybe suspend the rules going forward so you get some more evenness in there. In other words, do a rolling average instead of allowing these outsized profits and these outside losses as well. What do you think?
For me, a loss is a loss is a loss, and they should take them if they have them, and do not change the rules in midstream.
Guys, hold on one second. We got Connell McShane with some more information on AIG. Go ahead, Connell.
A couple of things here, Dave. I mean, well, number one is the amount of as a lot of these financial-related firms are doing. The AIG is looking to go out and raise more money, and they're looking like they want to raise capital to the tune of, it looks like about $7.5 billion in a stock offering to try to raise capital. Now, another interesting thing that we noticed here was that they're going to boost their dividend, which kind of seems strange, when you consider the environment and what else they had to say here. You guys were talking about the losses. You see at the bottom of your screen now, comparable number, $1.41 a share versus that estimate of 76 cents. So they're obviously losing, as Liz said a moment ago, double what the street expected. But also, and I guess this is what a lot of the firms are trying to do: go out in the market and raise more money because they need it. And it looks like at least $7.5 billion in a stock offering that they're going to raise here, and some more in debt as well. So $7.5 billion that the AIG obviously, guys, needs the money, and that's what they're trying to do here through this stock offering.
All right. Well, Connell McShane is on the story of AIG. He's going to tell us as soon as, by the way, the stock, I believe, is still halted. Well, it looks like it's moving a little now, Connell McShane. It's going down about just a couple of pennies. So at least there does appear to be some after-hours movement in that stock. We're going to be following that very closely. It stopped at 44.15. Looks like it's trading now at about 44.06. As soon as we get more information, we'll report it to you right here. Well, Treasury Secretary Hank Paul.
So what are the best energy investments now? Let's bring back our Bulls and Bears panel and also welcome our very own resident genius, Brenda Butner. Hey, guys.
I like that. Can I have that like on a chyron?
It's on your door now as we speak.
So you got to tell us, what's your energy play right now, Brenda?
Well, what I want people to know, the rest of these guys are smart, and they put money out every day, and they'll tell you what to buy. But here's what you need to know. You probably have more money in energy than you realize. I took a look at the Vanguard 500 index fund. Most 401ks have that. Energy is the #1 sector at 13%. That's more than Shivani said that you should have. ExxonMobil is its largest asset. So just realize that you're probably invested in oil more than you recognize. And to run into some of those other funds.
Peter Schiff, you got a lot of gold. You have any black gold in your portfolio, Peter?
Well, we've been investing in oil for 10 years. It's the biggest weighting that we have. Also alternative energies such as coal and natural gas, wind power, nuclear. But you know what? There's a relationship between oil and gold. And if you want to make a lot of money right now, forget about black gold. Go to the yellow variety. If you want to really make some bucks, buy some gold stocks. If you think what's happening in oil is impressive right now, wait till you see what's about to happen to the price of gold. There's no rush like a gold rush. This is going to be a stampede. So buy some stocks. They're just going to go straight up.
Well, what do you think of that, Brenda? Are you a gold bug?
No, I'm not. And I also, I worry about how much it's gone up, #1. And #2, you have to be careful what kind of stocks you buy. Like the mining stocks are not very good. So I'm steering clear unless you want to buy me a gold bracelet or something like that.
Todd, are you a gold bug? Let's get over to Todd. What do you think, Todd?
Yeah, it's run up so much, it hit 1,000 now, back below 900. It's so hard to realize a profit off of gold because, people hold it for a hedge and people hold it for security and people don't take the profit. And then, it might rise over 1,000 and go to 2,000. Oil might go to 200. I just don't believe either is going to happen.
All right. Well,
even
Gary,
in our irrational exuberance.
Gary, on oil, we have all these estimates now. Oppenheimer says it's overpriced at 70 a barrel. Goldman Sachs says it's way underpriced at 175 a barrel. Where do you think it's going to all end?
The major long-term trend remains up at this point in time. We've had short-term pullbacks, but this is monstrously strong, and you got to stay with the trend. And as I look at my list here, new high list, it is all oils, whether you're dealing with energy, whether you're dealing with natural gas like a Chesapeake. The only oils that are not working right now are the refiners like Tesoro and Valero. They're at new yearly lows, which beats the heck out of me. Why? But the rest of the group is on fire, and any pullbacks are warranted buy right now.
You know, Todd, there's thinking that OPEC will not let oil get to $200 a barrel. What do you think of that?
I think so. I just think of Alan Greenspan back in 1996. I think it's irrational exuberance. I think there's a mania right now in the oil markets. But I will say this, natural gas is someplace to look at, and I agree with Gary on Chesapeake. Natural gas usually trades 6 to 1 to oil. Right now it's trading 11 to 1. Even if oil comes back to $80, natural gas should trade around $13 to $14. It's trading right now a little over 11. So Chesapeake and Southwestern Energy, those two natural gas plays, I think are a great bet for the next 2 years.
Brenda, one thing we should mention, even the guy who said on Monday, Goldman Sachs guy who said it was going to go up to 200, he says there is eventually going to be a price at which all of these other oil sources are going to come online, the Canadian sands, all of the deep sea drilling, the ones that go as 5 miles deep, etc. And eventually there's going to be a glut of oil and the price will come down. He calls that the third phase. It may be a couple of years from now, but that's what he says.
A couple of years from now. It would have to be many years from now. And first of all, to get through Congress.
He says 2 more years.
No, I'm sorry.
Remember,
we're not going to start drilling.
He was right on $100 oil.
Yeah, but as long as this is politics, this is not markets. This is
remember,
you have to get Congress to allow to move past the environmentalists.
It's not.
Peter, what do you think?
It's not going to work because it's not a function of expensive commodities. It's a function of cheap money. Money is going to keep getting cheaper. Any energy source that we look at is going to get more and more expensive. We can't keep debasing our money and then be shocked when prices rise. And I think prices are not only reflecting how much money has already been debased, but how much it's likely to be debased over the next few years. People are going to lose a fortune if they keep their money in dollars, so they're buying oil and commodities.
Peter, unless Ross Perot is elected, he still hasn't pulled out, and he makes you the head of the Federal Reserve. It could happen,
Right.
Well, even if I was the head of Federal Reserve, I couldn't do anything to save the dollar.
Okay. All right. On that happy note, folks, we got to leave it there. But here's a look at who made money today. China's. We round out our show today with what you need to know. Gary Kaltbaum.
For about the last 3 or 4 months, the housing stocks had been acting better. I've been noticing it, but don't let that fool you. Housing is actually worsening right now as more inventory comes on and it is not being picked up. Housing stocks now are starting to break down again. I think they're headed back to the old lows.
Ouch.
Yeah, I think he's right. Peter, what do you got?
Well, I got a bigger problem brewing in credit cards. Paulson says the credit crisis is over. As usual, he couldn't be more wrong. It's just getting started in credit cards. Look what happened yesterday with a big jump in borrowing. Consumers are now coping with higher prices by charging things. They can't pay the money back, and the people who are lending the money are going to lose a fortune, and they're going to cut the American consumer off from the credit cards, and these credit card stocks that have been rising now are going to plunge when they can't get paid back.
All right. The whole world is coming to an end. Todd, what do we need to know?
Isn't it? It's just coming to an end. But Robert Gray's working too hard. Y'all shouldn't work him so hard. Okay, Edmunds.com had a survey, had a study out on how long it takes to recoup the cost of paying a premium for a hybrid car. And if you buy a Toyota Prius, it's going to take you 3.5 years of driving that Prius to recoup the price of the premium you paid for it and the savings on gas.
Yeah,
Todd,
makes sense. Brenda, what do we need to know?
I watch the money flowing into mutual funds. That's what average investors use. 3 times what they were the previous week to last week. So that's a sign that consumers, investors are starting to put money to work in the market. And I think it's a bullish indicator.
How much sitting there now? $4 trillion, I think?
Yeah, it's huge.
Wow, a lot of money.
So you think Hank Paulson's right? The worst may be over?
Yes.
Okay.
No, I think Peter Schiff is wrong, actually.
Well, he's been right on gold, folks,
People have been
for a
telling me
long
that for
time.
years.
All right.